Well, hello, and now we're going to be starting the next section of the course, and that's going to be dealing with capital budgeting projects. There's several components to that: estimating cash flows, then evaluating those cash flows, and then talking about how we finance these projects. So this is what we call the capital budgeting portion of the course, and it begins with this chapter here, Chapter 9, on estimating cash flows. Here we're going to be doing something very similar to what we've been doing so far, and up to this point we have valued other securities such as stocks and bonds and preferred stock. Well, here we're just going to be using those same tools to value projects. And as a manager, you're going to have to, at some point, assuming that you are in charge of a capital budget, you're going to have to evaluate how you're going to spend that budget. And what you'll want to do is spend that budget as efficiently as possible. And by efficiently, we mean you want to add the most possible value to the firm as a result of taking on a particular project. So that's what we're going to be doing in this section, is talking about, how do you choose those projects? How do you choose those optimal projects? So before we get into number crunching, though, there's quite a bit of background information we need to go through. So let's go ahead and start with that. First of all, there's different categories of investments, and they start at the top there. They start with easy to analyze down to difficult to analyze. So for example, safety and environmental outlays. When you have those types of investments facing you, generally those are things that you have to do, whether you're required by government to do them or whether you're doing it just because you want to watch out for the safety of your employees or perhaps your customers. And so those really don't take a whole lot of analysis. There, what you want to do is accomplish your goal at the lowest possible cost. The next one, replacement of a current asset, that one takes a little bit more analysis, but again, not too much, because you're already in that line of business. You're not having to forecast any real future expected cash flows or sales because you're already in that line of business. You're just trying to determine whether or not you need to replace an asset that you have, maybe that's just getting old, or maybe it's inefficient and you could replace it with something that would be more efficient. The third one, investments to increase capacity in the existing line of business. That one, it gets more complex because now you're getting into territory where you're going to have to really forecast whether you're going to get enough sales to justify this investment. And so, here you're getting into what we call riskier territory because you can be off in your estimates. But those are always interesting projects to look at. And then finally, we've got investments in new product lines or new ventures. Those are the riskiest of all because since it's an area where you haven't offered products before or particular services before, and it's a brand new area, you may have very little information as to what the sales demand, what is the product demand or the service demand going to be for whatever it is you want to offer. And when it's a new product line, oftentimes it's very difficult to estimate. So as you can see, as you move through there, estimating what those cash flows are going to be for a particular project become more difficult. Some characteristics of a capital project, basically to sum it up, they're expensive, they're big, they are usually part of a strategic decision. Generally, you have your strategic imperatives that are set, your strategic goals that are set, and then you're investing in projects that support those strategic goals. And so it's the outcome of these projects that determine whether or not you're going to meet your financial objectives. So capital projects are very, very important. It's important to evaluate these and make sure that you're making the right choices when it comes to capital projects. Making the wrong choice is very expensive because usually you can't reverse these. So making a wrong choice could cause you to lose a whole lot of money. So we'll be talking about exactly how you evaluate these. The key to adding value, the whole idea behind project investment is to add value to the firm, but the key to adding value then is to invest in projects that have values greater than their cost and allow your firm to maintain its competitive advantage. So that sounds very simple, just, it's kind of like calories in, calories out type thing. If you want to lose weight, then you take in fewer calories than you expend. If you want to gain value, then you spend less than you take in. But it's oftentimes easier said than done. Maintaining your competitive advantage means, your competitive advantage is what differentiates you from your competitors. So you always want to try to have some sort of advantage over your competitors that keeps customers coming to you. Some terminology that we need to be familiar with as we get into this section of the course. First, there are two different types of projects. There's independent projects and mutually exclusive projects. Independent projects are what you're going to be dealing with most of the time, if not all the time. And they just simply mean that you evaluate the project by itself to determine whether or not it adds value to the firm. It's not competing with another project. As opposed to mutually exclusive projects, they compete with one another for acceptance. So to kind of give you an example so you can see what I'm talking about, let's say that you need to buy new computers for everyone in the office. And so you are looking at a bunch of Dell computers, and then you're also looking at a bunch of Apple computers. Okay, you're either going to buy the fleet of Dell computers or the fleet of Apple computers, but you're not going to buy both. It'd be crazy to buy both. So they are mutually exclusive investments. In other words, they compete with one another for acceptance. So you would choose one over the other. Independent just simply means, your air conditioner breaks down, for example, you've got to put in a new air conditioner, and therefore you do it. So there's nothing competing with that. In terms of approaches to capital budgeting, there's the thought that there is such a thing as unlimited funds, and the thought is that if you have all the money available to you to invest in anything that you wanted to invest in, then you could accept every single project out there that would add value to the firm. But that's not realistic. Even if you go along with the idea that very large companies can issue tons of stock and bonds and really raise all the money that they would want, you can't manage that large level of growth. You've got to grow incrementally. And so firms just don't operate under the assumption of unlimited funds. So firms have what we call capital budgets, and that gets to the second point there, which means that they ration their capital. In other words, instead of saying, okay, we're just going to invest in every single profitable project that comes across the desk, they say, you know what, send us all the projects that you think we should invest in, saying this to all their mid-level managers, and then they'll look at these projects and analyze them. And let's say that you get 100 projects that come across your desk, and half of them, 50 of them, turn out to be projects that would actually add value to the firm, but your capital budget isn't large enough to fund all 50 of them. So let's say your capital budget is only big enough to fund 25 of them. So then what you would do is rank order those projects from most profitable, or I shouldn't say profitable, but adding the most value to the firm to the least value of the firm. They're all good projects, but some will add more value to the firm than others. And then you'll just invest in the top 25. And that's what, with capital rationing, the difference between that and unlimited funds is that we have to rank projects, and then we invest down from highest ranking project on down until we run out of money. Some other terminology: cash flow patterns. Most of the time you're going to be dealing with the conventional cash flow patterns. Most projects have that, and that just simply means that you're going to have a cost up front followed by a stream of benefits. So in other words, you invest in a piece of machinery today. So it's going to cost you $1 million maybe to buy that machinery today, but for the next 20 years you expect to get benefits from that machinery. So you're going to have a stream of positive cash flows. So that's what we mean by conventional cash flow. You have a negative followed by a stream of positive cash flows. A non-conventional cash flow means that you have a negative up front followed by a stream of positives, and then maybe another negative followed by another stream of positives. An example of that might be machinery that an automobile manufacturer may buy to produce a new model car, and let's say that they run this machinery for 5 years, but then now it's time to do a model change, right? They change them up every so often, and so they have to shut everything down for a while. Now you've got another investment where you're retooling, and then once you get retooled and you do the model change, then you have another stream of benefits. So you have the initial cost up front for the machine, followed by your stream of benefits, another cost where you retool, followed by another stream of benefits. That's a non-conventional cash flow because you don't have just the one investment followed by the benefits. Some principles of estimating cash flows. I like to go through these because oftentimes if you're not sure how to approach a number and a problem, sometimes if you come back to these principles, it might help you know how to treat the issue. One thing we want to keep in mind is that we are not dealing with accounting profits. We are dealing with cash flows, and they are different because accounting profits include things such as depreciation, for example, which is not a cash outflow, right? Depreciation is just the amount we depreciate. We bring the amount of the assets down in our accounting books each year to show that an asset is deteriorating, but we don't write a check out to depreciation, each year. So cash flows should be considered as opposed to accounting profits, and so you'll see that as we go through the cash flow formats. The other thing to keep in mind is we're always looking at cash flows on an incremental basis, meaning you're asking yourself the question, how much better off am I as a result, or how much better off is the firm as a result of taking on this investment? I have a piece of machinery right now that produces $20,000 a year in cash flows, but I can buy a more modern piece of equipment that would reduce the cost of operating this machinery, and so instead of producing $20,000 a year in cash flows, it would produce $25,000 a year in cash flows. Well, when I'm evaluating this new possible machine, I would evaluate it against a net benefit of $5,000 a year, correct? Because I'm only $5,000 a year better off if I buy this machine. I've already got a machine that's generating $20,000 a year in cash flow. This machine would give me $25,000, so it's only giving me $5,000 more. So we have to evaluate based on the incremental advantage as a result of buying the asset. And then last, cash flow should be considered on an after-tax basis. That's pretty self-explanatory. We'll take out taxes and everything else before we move on. All indirect effects of a project should be included in the cash flow calculations. That's kind of a catch-all for, there's just unique characteristics that occur with projects, and sometimes they'll impact the cash flows, and you just have to consider that. So it's kind of a catch-all for all those unique situations. Probably the most common one, now you won't run into these, but it's still important to know about them, I think, when I say you won't run into these, you won't run into it at this level, in your textbook, but in the real world, we do run into these, and a good one is cannibalization. Let's say that you're Coca-Cola and you decide that you're going to introduce a new soda that you haven't had before. And so what may happen is, by introducing this new soda, you may actually cannibalize the sales of some of your other sodas. In other words, some customers that drink some of your other sodas that you offer, Coke and whatever, will gravitate to this new product. Well, that's not an added benefit to you. Okay, the only added benefit to you are the new customers that you would draw away from, like, say, Pepsi, and they would purchase this product. So you would have to take out, when you're estimating the cash flows, you'd have to take out any cannibalization effects. So, like I said, you won't have to do this, but it's still good to know about it. Sunk cost. Sunk costs should not be considered. By definition, sunk costs are any costs that occur before the project is really under consideration. I like to use the example of, there's a couple good examples, just either reading a book or seeing a movie. I think people can relate to this as a sunk cost. Take the example of, let's say, reading a book. You went out and you bought this book and you paid $25 for it, okay, new hardback, and you didn't buy the electronic version, which would have been cheaper. So you spend $25 on this book. You're about a third of the way through the book and you decide this book is really bad. I don't want to finish this book. But on the other hand, daggone, I spent $25 on this book. Why? I hate to waste that money. So the decision is now, do you spend the additional 15 hours or however long it would take you to read the book just because you spent the $25 and you don't want to consider that money wasted? Or do you cut your losses and say, I've already invested $25 plus 10 hours of my time. I don't want to put any other, don't want to invest any more time into this book, so I'm cutting my losses. The sunk cost in that example is the $25 that you spent plus the 10 hours that you put already into the book. You don't want to keep moving through a bad book just because, gosh, you hate to have lost that money. That money's already spent. And whether you read the rest of the book or not, you're not going to get that money back. It's a sunk cost. And so sunk cost should not be considered. Now, what's a sunk cost for a project? It can be a number of different things. Oftentimes it's research and development, R&D. So maybe a company might say, gosh, we spent so much R&D money on this particular product. And now we have a competitor that's come out with something better than what we can come out with. What do? We can't kill it. We've spent all this money. And the idea is, certainly you can kill it. Kill it before it costs you more money, if that's what it takes. So what you've spent in the past is already sunk. It's already gone. So whether you move forward with a bad project or cut your losses and don't move forward, that money is spent. It's sunk. Finally, resources should be valued at opportunity cost. What that's saying is any resources that you use should be valued at current market prices. So for example, if your company owns a piece of land that it bought, say 10 years ago for $10,000, and now that land is worth $25,000, and you're thinking about building a warehouse, and as you're putting together your cost for that warehouse, you're trying to determine, gosh, do I put the cost of the land at $10,000 because that's really what it cost us to get the land, or do I put the cost at $25,000, which is what the land is worth today? And the answer would be that you would go with the $25,000 because by putting the warehouse on that land today, you are foregoing the opportunity of being able to sell that land for $25,000. So it's an opportunity cost that needs to be, you can't ignore that. It needs to be included in the analysis. Okay, before we get into the cash flows, we're going to have some background information we need to know about depreciation, taxes, and book values. So we're going to start out with straight-line depreciation, which everyone should be familiar with in your accounting course. But just as a quick review, we find that we can get the annual depreciation by simply taking the installed cost of the asset, which is the installation price, plus shipping, plus installation, plus modifications. So let's see, price, shipping, installation, modifications. Yeah. So any sort of modification you need to get that asset up and running for you is part of that depreciable installed cost, installed base. From that, you subtract an estimated salvage value, and there may or may not be a salvage value. A lot of times that's just zeroed out, but if the problem says there is a salvage value, then you would subtract that from the installed cost. And then you divide that by the estimated economic life of the asset, which would also be given to you in the problem. So to give you an example, we've got a company that's purchasing a machine for $12,000 and has an estimated salvage value of $2,000 at the end of a 5-year economic life. So therefore, to find the annual depreciation, you just take the purchase price of the machine, which is $12,000, subtract from that the $2,000 salvage value of the machine, and divide that by the 5-year economic life. So your depreciation would be $2,000 per year, every year for 5 years. Now here's where we get into the appendix of your book in the chapter, and I like to cover the modified accelerated cost recovery system as a method of depreciation, because truthfully most firms do not use straight line depreciation when they're working with capital investments. They actually use an accelerated depreciation method. There are several different accelerated depreciation methods out there, but this is the easiest one to deal with, and it is commonly used. So your textbook has this one, and we can go through this. The benefit in accelerating your depreciation expense is that the depreciation expense gives you a tax write-off, right? You get to subtract that from your income before you figure up your taxes. And at the same time, depreciation, like we said before, isn't an expense that you actually write a check for. It's not a cash outflow. It's just again a mark in your accounting books to show that an asset has deteriorated. So why not go ahead and write off as much of that depreciation as we can in the earlier years so that we can get the tax benefits as soon as possible. Now, over the life of the asset, and you see that in the third point there, over the life of the asset, your total depreciation expense is the same, whether you use an accelerated method like MACRS or whether you use straight line. It's just that with an accelerated method, you get to depreciate your asset faster. And we know that because of the time value of money, if we can save money in taxes this year as opposed to waiting 5 years from now, then that's a benefit to us. We can take that money this year and invest it and make money. So that's why most firms use an accelerated method. One thing about MACRS is it does use a half-year convention, and what that simply means is that regardless of when you actually purchase the asset, it simply assumes that you purchased it mid-year. Okay, so technically that first year when you're showing your depreciation expense, you're really getting a half year's depreciation, and I'll show you that again when we get into the numbers. And the other thing about MACRS is that it does not consider salvage value, so you don't have to worry about salvage value at all. With MACRS, there's a table, and that's contained in your textbook as well. And so what would happen is, and whatever asset it is you're evaluating will fit into what we call one of these property classes. So there's a 3-year property class, a 5-year property class, a 7-year property class, and there are ones that go beyond that, but they're for buildings. So we don't usually get into those in this course. But you will be using these that you see here on the screen. You'll be told in the problem what type of asset will fit in which property class. So you won't have to figure that out on your own. In the real world, the IRS does have very strict guidelines as to what type of asset fits in a particular property class, and so you would know which one to use. To kind of give you an example, technological items typically are in a 3-year class, automobiles, trucks, usually a 5-year class, and most of your manufacturing equipment would fit in a 7-year class. And so what you would do is take those percentages and multiply it by the installed cost of the asset to get your depreciation figure each year. Now the one thing you might notice, look at the 3-year column. What you're doing there is you're depreciating the asset over 3 years. I mean, that's what that 3-year recovery period means. But you've got 4 years worth of numbers, right? 33.33%, 44.45%, 14.81, and 7.41. So what it is it's 3 years worth of depreciation, but remember that half-year convention we talked about? So really that 33.33% is a half year's worth of depreciation. Then the 44.45% is a full year. The 14.81% is a full year, and the 7.41% is the other half year. So it's 3 years depreciation spread out over 4 years. In the same way with the 5-year, notice it's 5 years depreciation spread out over 6, and with the 7-year class asset, you would have 7 years depreciation spread out over 8. So we'll go through an example so you can see how those are calculated. Alright, so let's say GE purchases a $9,000 piece of machinery that required an additional $1,000 for shipping and installation. If the asset is depreciated under MACRS for a 7-year class asset, what are the annual depreciation expenses for this asset? First of all, we have to come up with our depreciable base. In other words, what is it exactly that we can depreciate? And remember, the formula for the depreciable base is the purchase price of the asset plus installation plus shipping plus modifications. Now here we don't have modifications, so it's simply the price plus installation and shipping, which comes to a total depreciable base of $10,000. So now what I'm doing is, since I was told in the problem that it fit in a 7-year class asset, I took my 7-year MACRS rates from the previous table I'd shown you, and I'm taking that $10,000 depreciable base, and to get my year 1 depreciation, I'm taking that $10,000 depreciable base on the previous slide and multiplying it by the 14.29%, so that my depreciation that I can claim in year 1 is $1,429. Then my year 2 MACRS rate is 24.49%, and again I'm getting that from the 7-year class asset rates for MACRS. Again, that table's in your appendix and also a couple slides back. So I'm taking that 24.49%, I'm multiplying that by the $10,000 depreciable base. So my depreciation then in year 2 will be $2,449. And I keep doing that until I go through all 8 years of that 7-year depreciable recovery period, and then you'll see there in that right hand column what my annual depreciation would be each year. Okay, so now we're going to go ahead and take a look at book values. So by definition, a book value is defined by being the installed cost of the asset minus its accumulated depreciation. So in other words, it's the amount of depreciation that's left on the asset. It also just happens to be the value of the asset that's shown on the balance sheet. So what is the book value of the asset at the end of year 3? So we have a 3-year-old asset that originally cost, let's say, $100,000 this time, and it's being depreciated using MACRS for a 7-year class asset. So that means we're going to go to our 7-year class again and pull down those percentages just like we did from the previous slide, only this time we're applying it to a $100,000 asset. And so you take that 14.29% in year 1 for MACRS, and that's going to give you depreciation of $14,290. So notice there for the book value, I've got the installed cost of the asset of $100,000 minus the $14,290 worth of depreciation in year 1 plus the $24,490 depreciation in year 2 plus the $17,490 worth of depreciation in year 3. And again, I got those 3 figures by simply taking the first 3 years worth of MACRS from the MACRS table for a 7-year class asset and multiplying it by the $100,000 installed cost of the asset. So going down to the next line, we can see then that total depreciation comes to $56,270. So for this asset that's 3 years old, more than half of it is depreciated. So the value on our books, okay, the accounting value, the book value of this asset is $43,730. Okay, that's how we would find the book value of an asset. Now the reason this is important is because sometimes when you're buying an asset, you're buying an asset to replace an older asset that you might already have. And if you can sell that older asset, then that gets included in the analysis. But there's going to be tax consequences possibly with the sale of that old asset. And the idea is if you sell the old asset for more than its book value, then you're going to have to pay taxes on the difference between the selling price and the book value. Or if you sell the asset for less than its book value, then you'll get a tax credit. And I'll run through those examples here next so you can see exactly what I'm talking about. But I just want to explain why it is that we're looking at book values. So there's 3 possible cases, if you have a problem where you're selling an old asset along with buying a new one. Okay, there's case 1, which is the easiest, and that's selling an asset at its book value. So I just went ahead and used round numbers here. Let's say we have an asset that has a book value of $50,000 and you have an opportunity to sell the asset for $50,000. So what happens in that case? Alright, well there's not going to be any tax effect because there's no change in wealth for the firm, right? Because all you're doing is you're taking $50,000 from net property, plant, and equipment on your balance sheet and moving it up into cash. Okay, there's been no change in the value of the firm or anything. There's just no no additional revenues. There's no tax effect. So that's case 1. That doesn't happen very often, but if it does, there's no cost. Case 2, what if we sell the asset for less than its book value? The asset has a book value of $50,000. You're able to sell the asset, let's say, for $20,000. So here we're incurring a loss because you can only sell the asset for $20,000. You're incurring a $30,000 loss because on our books, doesn't mean that's the market. The book value is not necessarily the market value. On our books, the value of this asset is $50,000. It's just been depreciated down to $50,000. But the market value is really only $20,000. Market value is just what we're able to sell it for. So if we sell it for $20,000, but our books show it's worth $50,000, we're incurring then a $30,000 loss. The good news, I guess, associated with that is we'll get a tax credit on that loss. So if we assume that the tax rate is 40%, and we'll be making that assumption throughout the chapter, I think it's always 40%. So if we assume the tax rate is 40%, then you would multiply that loss by the 40% tax rate, and that would give you what your tax credit would be, the tax credit that you get as a result of incurring that loss. So then really the net proceeds from the sale of the asset would be the $20,000 that you actually received for the asset plus the $12,000 tax credit. So you would end up netting out in that transaction a total of $32,000. The third case would be just the opposite. What if we show on our books that an asset is worth $50,000, but the market value is actually $60,000? So we're able to sell it for $60,000. So in that case, we're going to realize a $10,000 gain because we're getting $10,000 more than what it shows in our account, than the value shown in our accounting books. So since we're incurring a gain, then we're going to have to pay taxes on that gain. So again, if we assume a 40% tax rate, and the tax rate would have to be given to you, but like I said, it'll almost always be 40%. You multiply that by your gain, and we'll have to pay $4,000 in taxes. So then really by the time you pay your taxes out of that, let's see what our net proceeds are then. Okay, well we received $60,000 for the asset, but we had to pay $4,000 in taxes, so the net proceeds from the sale is $56,000. Now, what I would suggest that you do at this point is to pause this PowerPoint, and I have loaded on Sakai a series of application exercises, and the first one is called Depreciation and Taxes exercise, and it gives you an opportunity to see if you can calculate the net proceeds associated with the sale of an asset. So you're just practicing the calculations that we just went through. I also have a separate file that gives you the solutions to the exercise. So test yourself first, see if you can calculate what you expect those net proceeds to be, and then check yourself against the answers and see if you got that. So again, pause, and then you can join us back for the rest of the PowerPoints. Now we're ready to jump into our cash flow components, and there are three cash flow components. There is the net investment, the net operating cash flow, which goes by a couple of different names. Sometimes it's just called the net cash flow, net operating cash flow, net benefits, operating cash flows after taxes, just kind of a variety of names. So, basically it's the net benefits you expect to receive. Then there may or may not be a terminal cash flow. Some problems you'll have a terminal cash flow, some you won't. Generally, if you sell the asset, if you're expected to sell the asset at the end of its life, then you'll have a terminal cash flow. So the net investment just says how much money you have to put up front to, what's the net amount it's going to cost you up front to acquire this asset. Net operating cash flow is what are the net benefits, and the terminal cash flow is is there anything you're getting back at the end of the life of the asset. So first we'll look at the format for the net investment, and the format's pretty straightforward. You have the purchase price of the asset plus shipping, installation, and modifications. And I will remind you that it's these first two components, the purchase price plus shipping, installation, and modifications, that make up the depreciable base, right? It is not that bottom line net investment that makes up the depreciable base. That's a common error on the exam, so that's why I wanted to clarify. So it's the sum of those first two items that I have up there. That's the depreciable base. So we move past that, and we see if you are selling an old asset, then you would want to subtract any money that you would expect to receive from the sale of the old asset, plus or minus any taxes that are resulting from the sale of the old asset, plus or minus any change in net working capital. Okay, and again, the plus or minus taxes resulting from the sale of the old asset, we just talked about that. If you're selling it for more than book value, then you're going to have to pay taxes. If you're selling it for less than book value, then you'll receive a tax credit. So that's why you have the plus or minus. And then plus or minus any change in net working capital, we haven't talked about that yet. But the change in net working capital, and we'll go through an example of that in just a minute, but the change in net working capital is the change in current assets minus the change in current liabilities that are necessary to support that asset. And you total all that up and you get a total of that gives you your total net investment, so the net amount of money that you have to put up front. There's the net working capital explanation I was kind of talking about. So to arrive at the net working capital, you'd have to be given this information in the problem. You know, sometimes you're just told there'll be an increase in net working capital of $10,000 or some amount, and then you just would include that. That would be something you'd add to your net investment. But to be more specific, your net working capital is found by taking the change in your current assets minus the change in your current liabilities. So let's think of how net working capital might be impacted by an investment. So let's say that you're thinking about adding a new product to other products you already offer. Well, so if you're going to add a new product, that means then you're going to invest in some machinery that's going to produce this new product. Well, when you invest in this new machinery, you're also going to have to invest in probably new raw materials inventory, right? So you'll have more money invested in inventories than you would before, because you're going to need raw materials inventory to actually produce this product. And then you'll have more goods in process inventory, more likely. And then you'll have more finished goods inventory, because you're going to have to hold a certain level of finished goods to be ready to ship out to your customers. So you're going to have more money tied up in inventory as a result of making this investment. Hopefully, as you sell more of these items, oftentimes when you make sales to customers, it's on credit, it's on account, and so your accounts receivables may increase. And if your accounts receivables increase, then that will mean that you've got more money, again, invested in your accounts receivables than you had before, right? You'll have more money tied up in that accounts receivables. So that would also increase your net working capital. Now, and it's also, and I've got cash in there too, because it's possible maybe because as a bigger firm with more bills to pay and stuff, by adding this new product, you might have to keep a little bit more cash on hand as well. What helps offset this increase in current assets would be an increase in accounts payable. And accounts payable, if you remember from accounting, is money that is owed to your suppliers for inventories that you purchase. So if you're purchasing more raw materials inventory, well, if you're charging that purchase, then your increase in accounts payable will help offset the additional money that you're having to invest in your inventories. And so it's the net difference between those two, in other words, the change in current assets minus the change in current liabilities, that make up your net working capital investment for this particular asset. It is important to understand, what net working capital is and how it's calculated. We'll go through, we can go through an example of that again in class. I think it's pretty straightforward here, but like I said, a lot of times it's given to you, but not always. Sometimes you might have to actually calculate the net working capital yourself, and you would just take the increases in those current asset accounts, subtract from that the increase in your accounts payable, and then that would give you your net working capital. Next we get our net operating cash flows, so that's the second cash flow component. And under net operating cash flows, what you want to do is for each year you want to find the expected, remember we're talking about incremental, so you want the change in revenue. So what's going to be, is there going to be a change in revenues as a result of investing in this asset? There may not be. Maybe there isn't an increase in revenues. Maybe instead it's just more efficient and it decreases your expenses. And so that's what your benefit is. So it could be an increase in revenues or perhaps a decrease in expenses. But you would take the change in those two, and that would give you your change in earnings before depreciation and taxes. And you might as well get used to that acronym there, EBDT. That'll be used a whole lot. And there, that is just, as I said, it's the change in earnings before depreciation and taxes. And then from that, you want to subtract your depreciation expense on the new asset, and that will give you your change in earnings before taxes. And then you subtract your taxes, and that gives you your change in earnings after taxes. And then you subtract any additional net working capital, which you don't run into unless you're working any of the challenge problems in the textbook. And then you will have some additional net working capital, but again, I'll talk to you about that in class. On the exam, you won't have additional net working capital to take out, but still, just to know how to know how to handle that. And then we add back in our change in depreciation expense. So the question we ask first of all is, notice how midway through that screen there you see that I subtracted my depreciation expense, and then I turn around at the bottom and I add it back in. So why do I subtract it and then turn around and add it back in? And the answer to that question is, I subtract it because, as we mentioned before, it's a tax-deductible expense. So I take out my depreciation expense before I can figure out my taxes. But then I turn around and add it back in before I get to my net operating cash flow, because depreciation expense is not a cash outflow. So leaving it out would underestimate the cash flows that we're actually getting from this asset. So we want to add that depreciation expense back in because we really didn't release any cash on that depreciation expense. And so when you total that up, you get your net operating cash flow, and you're going to have to compute a net operating cash flow for each year of the life of the asset. We'll work through an example. Okay, and then finally we get to our terminal cash flow. And so, as I said before, you may or may not have a terminal cash flow. It just kind of depends. If it says in the problem that you can sell the asset for X amount of dollars, or the asset has a market value of X amount of dollars at the end of its life, then that means you are going to have a terminal cash flow, and you are to assume that you can sell that asset for whatever they say in the problem at the end of its life. And the taxes resulting from that sale depend on the book value. If you're selling it for more than book value, then you're going to have to pay taxes. If you're selling it for less than book value, then you're going to get a tax credit. So you would have to consider that. And then finally, there is what we call recaptured net working capital, and that is if you've had any net working capital investments. In other words, if you've had to invest money in your current asset accounts to support this asset, then the assumption is automatic that you can recapture all those net working capital investments unless the problem states otherwise. So, if you had to invest an extra $50,000 in inventory to get all the inventory you need to get this project going, and your accounts receivables, you have an extra $100,000 invested in your accounts receivables, as this product began to sell, then the assumption is, this is the default assumption. The default assumption is that you will eventually sell all that inventory and you will eventually collect all those accounts receivables, so you will recapture your net working capital investments unless otherwise stated in the problem. And so you sum that up to get your terminal cash flow. So let's go ahead and work through an example. So I have this problem here called the Peoria processing problem. So Peoria Processing has an opportunity to invest in a new device that will replace 2 of the firm's older machines. This device will cost $970,000 and will require an additional outlay of $30,000 to cover installation and shipping. The new device will cause the firm to increase its net working capital by $20,000. Both of the old machines can be sold. The first one can be sold for $100,000 and it's fully depreciated, so it has a book value of 0. The second can be sold for $150,000 and it too is fully depreciated. The original cost of the machines were $200,000 and $140,000 respectively, and that's actually irrelevant information. You don't need that. And the firm's tax rate is 40%. Okay, let's stop there, because right there in that first paragraph I have really all the information we need to do the net investment. So why don't we just take that first set of information there, and from that figure out, okay, how much money are we going to have to set up front in order to acquire this new device. Okay, so following our format, it said in that first paragraph that the cost of the proposed asset is $970,000. It also specifically stated that installation, shipping, and modifications come out to be $30,000. Which, by the way, notice that the sum of those first 2 parts, which come to be $1 million even, would be my depreciable base. Okay. Now, in this problem, this new asset would replace 2 old machines, machine number 1 and machine number 2. And it said that we would receive $100,000 for machine number 1, so that's why I've got the parentheses around that to represent a negative number, because we're trying to calculate total money out. You know, the total money we're going to have to pay out. You'll see net investment there is $870,000. So that $100,000 is actually money coming in. So that's helping us. So we're going to get really a total there, you'll see, of $250,000 of money coming in from selling machine number 1 and number 2. Now, we'll also have to pay taxes on the sale of machine number 1 and number 2. So how do we go about figuring up our taxes? Well, I'll show you that here on the next slide. So you see here, we're going through the same little process we went through earlier. With asset number 1, it says we can sell it for $100,000, but it's got a book value of 0. So as you can see, we have a $100,000 gain, and we're going to be taxed then on that entire gain. So we'll have a $40,000 tax liability. And then with asset number 2, we're selling it for $150,000 and it has a 0 book value. So we got a $150,000 gain that's going to be taxed. And so you'll see there you've got a $60,000 tax liability. So now we go through and put that into our net investment. Okay, so you see there where I've got the proceeds that we'll receive. So in other words, the sales dollars that we're going to, the sales dollars we're going to receive for machines number 1 and 2. And then from that, notice I put in there that we're going to have to pay taxes though of $40,000 on the sale of machine number 1 and $60,000 in taxes on the sale of machine number 2. So technically, you know, if you want to look at those 4 items there together, the net proceeds from machine number 1 is actually going to be a net of $60,000, and the net proceeds from machine number 2 is going to be a net of $90,000, but I just have it separated there nicely so you can see it. And then the change in net working capital was given in the problem to be $20,000, so you didn't have to calculate that yourself, but that just tells us that we're going to have an additional investment in net assets of $20,000. And so we total that up, and it comes to a total of a net investment of $870,000. So that $870,000 represents the total amount that we're going to have to invest today, time period 0, that's the assumption, in order to get the net benefits. And we'll look at the net benefits next. Okay, so going back to our Peoria processing problem, we took care of the first paragraph there. The second paragraph describes our net benefits. So if we buy this new device, it's expected to save them $225,000 per year before taxes. And this asset's expected to have a life of 12 years, and it's going to be depreciated using MACRS for a 7-year class asset. Boom. Okay, we have everything we need right now to calculate our net benefits. So what do our net benefits then look like? Now notice this asset doesn't say we're going to get $225,000 a year in revenues. It just says it's going to save us. So there's some sort of efficiency or something going on here. But what that translates to is if you have a $225,000 reduction in expenses, then that means your EBDT, earnings before depreciation and taxes, have to increase by $225,000. So here's what the operating cash flows look like then. And I took each one out separately, and because I ran out of room, I had to, once depreciation's done after year 8, the cash flows for years 9, 10, 11, and 12 all look the same. So those cash flows do occur 4 times, but let's start at the beginning. So we have earnings before depreciation and taxes of $225,000 a year every year for 12 years. Okay, and you'll see I've got it there. Now, truthfully, in real life, we would have some sort of inflation factored into that, but right now we're keeping things basic. So we just have flat $225,000 a year in savings, which means we have an increase in earnings before depreciation and taxes of $225,000 a year every year for 12 years. Okay. Now we need to subtract our depreciation each year. So how did I get my depreciation figures? Well, if you go back, and you can flip back some slides, if you go back and look at the net investment, remember that we saw that the depreciable base was $1 million, right? It's the $970,000 purchase price plus the $30,000 installation shipping. So when you total that up, it comes to $1 million. We're also told in the problem that the asset is being depreciated using MACRS for a 7-year class asset. So I'm taking that $1 million and I'm multiplying it by 14.29% to get my depreciation of $142,900 in year 1. I'm multiplying it by 24.49% to get my depreciation in year 2, and so on every single year. Also notice that after year 8, it is fully depreciated. But it says that the asset has a life of 12 years, so we have to keep going with the cash flows. So year 9 depreciation is 0, year 10, 11, and 12 depreciation is still 0. So then to get so I've got earnings before depreciation taxes minus my depreciation. Next in line there you'll see it leaves me my earnings before taxes. So when I just subtract my depreciation from my EBDT, I have earnings before taxes in year 1 of $82,100. In year 2 it's negative, and that's okay, negative $19,900. Year 3, $50,100, and so on. Okay. Next, I subtract my taxes, and I'm told my taxes are 40%. So to get my tax numbers, I take my earnings before taxes in year 1 of $82,100, and I multiply that by 40%. And when I do that, I get a tax liability of $32,840. And I've got that listed there. That's what I'm going to have to pay in year 1. In year 2, since I have negative earnings before taxes, I actually receive a tax credit. So I take the 40% and multiply by 19,900, and that gives me a tax credit of $7,950. So since it's a tax credit, I get to actually add that in there. It's money coming in, so I'm subtracting a negative, there, and so it's actually adding that number. And to go through one more year, in year 3, my earnings before taxes is $50,100. I multiply that by 40%. Gives me a tax liability of $20,040, and I do that every single year all the way across to get my taxes. Then I simply subtract my taxes from my earnings before taxes to get what I have there is EAT, earnings after taxes, of $49,280 in year 1, still negative in year 2. That's okay, but not as negative as it was before, right? Because we got a tax credit. And then $30,060 in year 3, and so on. Now I add back in my depreciation that I took out earlier because it's not a cash expense, right? So notice in year 1, up top, we took out depreciation of $142,900. Now down here at the bottom, we're going to add it back in. Okay, we only took it out at the top because we had to take it out in order to figure up our taxes. But we're adding it back in at the bottom because it's not an actual cash outflow. And I do that again for year 2. So year 2, notice we took out depreciation up top there of $244,900. I add it back in down at the bottom. In year 3, we took out $174,900. I add it back in down at the bottom. And then finally, when you add that depreciation back in, you notice you get operating cash flows of $192,160 in year 1. Year 2, we're actually positive now at $232,950, and so on every year. You see that. And then I do want to point out that in year 9, you end up with the operating cash flow of $135,000. In year 10, you also, again, end up with $135,000. In year 11, another $135,000. And in year 12, $135,000. Okay? That occurs each year for 4 years. I just didn't have enough room there on the slide to put all that in there. Okay, so now at this point, what I would suggest is pause, and then you have a Briggs and Stratton problem where you're asked to do a net investment and then do the net cash flows. There isn't a terminal cash flow in this problem. You'll get extra practice with that in your textbook problems because you'll want to do those 2 for sure. Practice really helps a lot with this chapter. But just give that a shot, and then the solutions are on Sakai. And you can download the solution file and see how you did with it. And then go ahead and pick up with the next slide, and we'll talk about the terminal cash flow. Okay, so we're back to our Peoria processing problem, and that third paragraph down there gives us the information we need for our terminal cash flow. So the book value of the proposed asset is 0 at the end of its 12-year life. However, it's estimated that the asset can be sold for $100,000. So another way of stating this is that it has a market value of $100,000. Now, in addition, $10,000 of net working capital may be recaptured. Okay? Typically, if you go back up and look at the first paragraph, you'll see that our net working capital investment was actually $20,000. Typically, we would expect to recapture all $20,000 back in the terminal cash flow. But Since it's stated otherwise in this problem, for some reason, maybe some of the inventory is obsolete, we don't know what the reason is, but for some reason we're only able to capture half of that. So in our terminal cash flow, we're only going to recapture then $10,000 of our net working capital. So what does our terminal cash flow look like for this problem? So here's the terminal cash flow, and so we have this proceeds from the sale of the proposed asset. So this is what we expect to sell this new asset we're considering. Okay, this is what we expect to sell it for when we're done with it 12 years from now. We expect to sell it for $100,000. By then the book value is zero, right? Because after year 8, there's no depreciation left on that asset. Remember, years 9, 10, 11, and 12 had zero depreciation. So it's fully depreciated, so therefore you're going to have to pay taxes on the entire $100,000. So taxes on the sale of that asset will be $40,000, assuming a 40% tax rate. And then we get to recapture that $10,000 worth of net working capital that they mentioned in the problem. And so our total terminal cash flow, which is money that we expect to receive at the end of the project, is going to be $70,000. So finally, here is a summary of what the cash flow components look like for the Peoria processing problem. At time period 0, our cash flow is a negative $870,000. That was our net investment. Okay, so that's our investment up front. Then in year 1, we saw from our net operating cash flows, we expect to get $192,160. And in year 2, $232,960. In year 3, $204, and so on. I condensed, if you noticed in our cash flows, years 5, 6, and 7 had the same cash flow each year, so I combined them here on the slide. But keep in mind that $170,720 occurs 3 times. It occurs in year 5, year 6, and year 7. Then in year 8, it was $152,800. In year 9, 10, 11, and 12, our net operating cash flow each of those years was $135,000. And I broke year 12 out separately because in year 12, not only do we have the net operating cash flow of $135,000, but we also have to add to that our terminal cash flow, which we expect to receive. The assumption is you receive it at the end of the life of the asset of $70,000. So really the total for year 12 is $205,000. So at this point, all we've done is estimate the cash flows associated with this project. We haven't evaluated them yet to see whether or not this is a good investment. That's the next chapter. We'll do that the next chapter. You can't just add these up. You just can't add up these cash flows and say, oh, well, we're going to make a lot more money than we're going to have to spend, because remember, we've got to consider the time value of money, and we have not considered the time value of money. That has to get incorporated into the evaluation process, so that again will take place in the next chapter. But we've done the first big step, and this is the big long step, and that is coming up with those cash flow estimates. So congratulations, you have made it through this chapter, and please work through problems at the end of your chapter and practice, and I will be happy to answer any questions I can when I return. Have a good evening.